Palisade Radio is brought to you by First Majestic Silver Corp., one of the world's purest and fastest growing silver mining companies.
Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell, and on the line with us today is a new guest to the program. His name is Russell Fryer, and he's the Chief Investment Officer of Baobab Asset Management. Russell, welcome to the program.
Thanks, Colin, for having me. I'm excited to talk to you today.
Yeah, well, I was excited to get in contact with you because you're a rare breed. You have a commodity fund, and you're focused, overweighted on uranium. Particularly for this year, you see the fundamentals for uranium all lining up for a potential rise in price. And of course, the companies in the uranium sector are historically quite cheap right now, so it's a very compelling area to put your money. Let's start out, Russell, by just telling a little bit about your background and how you got interested in the commodity sector.
Sure. So I started investing in the mining industry in South Africa in 1990. So I've been investing globally for about 25, 26 years. And, anybody who's been around longer than a decade knows that everything's cyclical. And right now we see a lot of potential cyclical upside. The last couple of years have been diabolical for the commodity sector. Everybody's focused on China and potentially India and what's going on there. We've got a kind of a contrarian or different outlook on how we're looking at things. We actually think the place to be is the U.S. And I guess I'll get into that here a bit later. But we think the U.S. is actually going to be the driver. And even if the U.S. just grows at 2% per annum, on a $16 trillion economy, that's still a big number. And sure, China is the big growth area in terms of consumption, but it still has a ways to catch up. So while everybody's looking at maybe supplying uranium to the Chinese or the Indians, we think that the thesis that people are missing is the USA production or the lack of production. So that's kind of what we've been focused on over the last 3 or 4 years since Fukushima happened.
Yeah, that's great. And one of the reasons that I just jumped to get you on the show is you're so well versed in the uranium sector. At this point, you might have a better idea than me, but there's very few real companies left in the sector. Investors' options in terms of which companies or where to place their money is a lot less than, say, in the gold sector. And you made a good point before we got on the program here that those funds overweighted, particularly in gold, precious metals, have had a superb first couple of months to 2016, but your interest still lies quite a bit more in uranium. So why is it that you're so interested in uranium at this point?
To take a leaf out of the gold sector's book, we look at Baobab, we look at all-in sustaining costs, and it's a relatively new metric that the gold industry has used over the last few years, and we apply it, all-in sustaining costs, to the uranium sector. And what we're seeing is companies are running around saying that they are $25, $30 costs, but the reality is that's cash costs. And when you start to add sustaining capex, exploratory capex, royalties, etc. on this, a lot of these quote-unquote lower-cost uranium explorers or near-term producers are closer to $50. So one of the things that really excites us in the thesis that we kind of look at is the advantage of mill ownership. And you say, well, what's the advantage of mill ownership? Well, you saw that recently the fission in Denison potential transaction. Denison has an equity interest in the mill there in Canada. And our thesis is he who controls the mill controls the region. And so there's very few mills there in the Athabasca region. There's very few mills or mill licenses in the United States. And, one of the companies that we follow very closely is Energy Fuels. And they own one of 4 mill licenses in the U.S. And therefore, our belief is as uranium price increases, that mill, the White Mesa mill, is going to become increasingly more valuable. And it's kind of interesting to us that, a company like Energy Fuels has a market cap, 120 million, and yet you have these explorers that may or may not be in production in 10 years that have tripled the market cap, and it just makes no sense. So, we kind of look at those type of disconnects and say, here we have some latent and hidden value in companies like Energy Fuels. versus exploratory companies that have 300-400 million market caps that have no mill license pathway. They haven't even started to license a mill. They have no outlet for their ore, and so we kind of look for those type of disconnects. We know that Rio Tinto and Sweetwater, Rio Tinto has that Sweetwater mill that's been kind of mothballed. We know that Anfield has a shooterine that they're looking to augment and restart, and we know that Western Uranium has the Pinyon Ridge mill license that they bought from Energy Fuels that George Glazer is looking to build here in the near future. So, you got 4 mill licenses in the United States. They're tougher to get than a NFL team, an NBA team, a Major League Baseball team, and I doubt there's going to be very many more mill licenses allowed in the United States over the next decade or so.
When we were on the phone last week, Russell, you ran through a very cool exercise, and you did talk about the all-in sustaining cost, which is a very important way to look at these different deposits. And you were talking about the mills. There's only a select amount of companies that have the mills, which is very important. There's also then the amount of pounds in the ground, and if those pounds are accessible and which different ways that they will be mined. How much of your interest in these different companies is purely looking at from an optionality standpoint of this company has 100 or 200 million pounds in the ground, and as the price of uranium recovers, we will get a huge increase in the market cap just based on those pounds in the ground?
I don't look at so much the pounds in the ground as on an optionality basis as an investor, and the reason why is because you have companies in the Athabasca Basin who have 1-2%, sometimes even higher intercepts from their assays. That may or may not be in production in 10 years, maybe 8 years. I can't tell you what I'm going to eat for dinner tomorrow night, let alone can I tell you what the uranium price is going to be in 10 years. And so I think a lot of the explorers that we see, not only in Athabasca, but in the U.S. and globally, have little chance of actually coming into production, and they're just hoping to get purchased. I look at somebody like Uranium Energy Fuels that has 130 million confirmed measured indicated pounds, and I'm thinking they've got the mill, they've got the number one uranium holding in the United States, and so as uranium goes higher, I want to own those that are in production because I can't tell you what's going to happen in a couple of years from now. Hopefully, God willing, it's not another Fukushima type incident. But those companies that are not in production in the next year or two, I think could be pie in the sky type investments. So, because we manage, high net worth individual and foundation capital, we need to be a little bit more prudent. There are opportunities in the United States that I think that are massively undervalued. So I don't think that there's any real reason to be aggressive in places like Africa. And the grades in the United States are, 2,500 parts per million versus 200 ppm in places like Namibia and elsewhere. So I just see no reason to really venture out of North America right now.
Okay, and in terms of the type of deposits that you're looking at, do you prefer hard rock over ISR production, or does it depend on the different type of company and deposit you're looking at?
It's actually a bit of both. We fundamentally are hard rock focused, but as the recent Energy Fuels and Uranus deal has shown the market that they've actually diversified the risk per se by picking up that ISR deposits there in Wyoming. We've actually followed UI Energy very closely. I think Jeff Glenn has done a great job. We like hard rock mining fundamentally because we can put down a drill pattern and follow that. Also, too, I like hard rock mining, particularly in western Colorado, because a lot of the sandstone-hosted deposits have vanadium co-credits. And if you look at Western Uranium and Energy Fuels in particular, for every ton of ore that they mine in the Urban belt, they get 5 times of the vanadium for every 1 part uranium. So as vanadium becomes increasingly more important in the world, whether it's renewable, rechargeable battery units, or in the military because vanadium is used in high-quality steel, you're going to start to see those two companies' cash costs drop measurably. I mean, there's a situation really that if vanadium gets to $10 or $12 a pound, you might see some of the uranium come out of Energy Fuels or Western Uranium almost for free. So we like those type of risk-reward metrics.
Okay, and now talking about specific companies that you are either invested in or like or both, you've already mentioned Energy Fuels a bit, so let's start there. Maybe you can just walk through briefly and break down what it is that's so compelling relative to the other companies out there and why Energy Fuels is one of your top picks.
Well, first and foremost, they have the White Mesa Mill. And if you look at some of the juniors and some of the explorers, they'll announce that they have an offtake agreement with White Mesa Mill, a toll milling agreement. And that toll milling agreement basically says Energy Fuels gets 50% of the value, and the company that actually sends the ore to White Mesa Mill for processing gets the other 50%. That's a win-win for Energy Fuels. They get 50%, and they can kind of control the region. So I like Energy Fuels for that. I also like Energy Fuels for the 126 million pounds. I know that they're going to be around for 30 years, and I like it that they're focused in the United States. Again, our thesis is the advantage of USA production. And if I take a step back, the U.S. is still the number one consumer of uranium. It consumes approximately 53 million pounds per annum, but only produces about 4 million. And we know that some of the listed utility boards have come out and said to the uranium buyers, we want to give preferential access to U.S. Mines that mine uranium, and we don't want to import from, call it, ex-Soviet Union type countries, because we don't know what's going to happen on a geopolitical basis. And so I would expect some of the RFPs that come out will be more focused towards U.S. producers. And if you think about it, there's only a handful. And so that's an area that we like to be exposed in. So we like Energy Fuels.
And while we're on Energy Fuels and the White Mesa Mill, let's touch on Western Uranium, which is a company most investors are not aware of, but one that you find quite compelling. In fact, you're on the board of Western Uranium. What can you tell people about that company?
Well, they just came out with an announcement this morning, and it's interesting that the CEO of Western Uranium, George Glazer, was the previous CEO of Energy Fuels. And George had taken over some of the Energy Fuels assets, which were actually in production, brownfields mines, previously owned by Denison. But one of the two key, advantages of energy that Western Uranium has is, they have the Pinyon Ridge Mill license that George Glazer plans on building. That'll be the newest mill in the United States. And if you think about, again, my thesis of the advantage of mill ownership or mill license ownership, this will be the 2016 version of an automobile versus some of the older mills that were built in the 1980s. So they'll be more efficient. Recovery should be more efficient. Obviously, it creates jobs, and I think that's a real win for Western Uranium. The second point is they have the ablation mining technology, which is a proprietary mining technology that Western Uranium will employ underground, and that should reduce the cost such that Western Uranium should probably be, if not the lowest cost, let's call it the lowest quartile producer in the world, and that includes the Kazakhs and the Uzbeks. So George Glazer has a real winning formula there. Unfortunately, the market doesn't know much about it, but I'm sure they'll hear more about it as Western Uranium grows. And the other point about it is Western Uranium has 100 million pounds of JORC and 43,101 pounds of uranium, second largest in situ holder in the United States, and 34 million pounds of vanadium. So again, if you think about Energy Fuels and Western Uranium's advantage over some of their competitors, they've got the vanadium co-credit. So both those costs should drop, the all-in sustaining costs, as the vanadium price creeps higher. Vanadium over the last month or two is up 30%. So, I'm very, very bullish on Western Uranium.
I heard that you mentioned UR Energy a little bit earlier in our discussion here. I don't want to put words in your mouth, however. I don't know if that's on your top investment list. Is that one that you're interested in as well?
Oh, very much so. We owned it. We've owned it in the past. I think Jeff's done a great job. He has one of the few CEOs that has bought into the all-in sustaining cost type of model, where when you listen to Jeff present, he will tell you what his cash costs are. He'll give you the royalties and payments, the exploratory capex, sustaining capex, and he'll throw that number out there. So I guess the only issue with UR Energy, which isn't an issue to most people, is just the longevity. Ideally, I like to look at mines that have at least 20 years life of mine, and I think with a bit of drilling on that ISR properties that they have, you could get there. But I like the story, and they're in production. If you think about it, they're one of the few U.S. companies that are in production. So we follow UR Energy and Jeff Glenda's group very closely.
All right, and Russell, what's maybe one or two of your other favorite picks that you've invested in the uranium space?
Well, I'll tell you one that I'm watching that we haven't invested in, but I think the Dewey Burdock is quite an interesting deposit, is Izarga. And so what we do is we strip out all the holdings of Izarga and just focus on the Dewey Burdock, and we think that'll be permitted and up and running in a few years. The grades are quite high, management's rock solid, uranium focused, and so we follow that one very closely, although we're not invested. And obviously UEC. UEC is kind of an interesting story because it's also in the Four Corners region plus Texas, and also then the South American, the Paraguayan property. We put the Paraguayan property there at zero and just kind of look at what they have in terms of the Four Corners plus Texas region. We think actually that there'll come a point in time, whether it's 12 months or 24 months, that some of those Four Corner regions and Texas companies will start talking to each other, and you could see a big consolidation play in that region to make, call it a competitor on a U.S. basis to a Cameco type or to a Riva type. So I think that Four Corners region plus Texas is quite exciting to invest in.
And one area I've noticed that you've kind of skated over and maybe will be a little interesting to investors. It's understandable to not look at the risk of, say, Africa at this point with the companies in the United States being so cheap. But how about the Athabasca Basin? For example, Denison with their mill and high-grade deposits right nearby. Cameco obviously focused quite a bit up in the Athabasca. Is Canada not of interest to you at this point?
Oh, very much so. I look at multiple times a day the Canadian producers. Obviously Cameco is the go-to name for both the retail and the institutional. We don't own it. We actually enjoy analyzing the Athabasca Basin. And the reason why is because, you see these companies, who are staking real estate in the region. Again, they're staking real estate, but it doesn't mean they'll ever be in production. And so I look at the Athabasca Basin, people talk about 1%, 2% type grades. And then I turn around and say, okay, well, George Glazer has ablation mining technology, which actually produces, after it goes through the ablation mining process, Athabasca type grades. So, Western Uranium can produce 1% to 2% grades, similar to Athabasca, except for Western Uranium will be in production 2016, 2017. So I look at what's going on at Athabasca, Patterson Lake. I look at the fission Denison issue. I watch the Chinese come in and say, okay, we'll buy 19.9%, but, we want 33% of your offtake. It's spot minus a number. And, all you have to do is look at and ask John Boshoff what he thinks about the Chinese, and certainly his experience with the Chinese in Paladin, to let you know that sometimes maybe it's better not to have them as partners. So we watched that Athabasca region very, very closely.
Since you brought it up, Paladin Energy, I wanted to ask you about that. Their main focus in terms of mining is in Australia right now, and their share price, I took notice of it last week, is extremely low. Their market cap is quite low considering that they're a producer, but they also have some debt issues. I didn't really get a full grasp on the Paladin story, and I'm sure you're familiar with it. What do you think about Paladin?
Sure. I actually really like it. They've got that Langer Heinrich mine there in Namibia, and they got the Kalakuri mine there in Malawi. And Kalakuri was actually a producing mine for a while, created jobs in Malawi. Unfortunately, due to the spot uranium price, they put it just on care and maintenance in the short term. What I do like is that they've named Alex Molyneux as CEO. They've shedded that interim label. And I think that's critical because Alex is very talented, and he's been able to cut costs. He's taken down the debt, and the Langer Heinrich, or the Langer Heinrich mine they produced, 260 pounds in the recent quarter. So that's 1,000, obviously. So, the cash costs are $25, $26. That's not all in sustaining costs, but yet the trajectory is on the downward slope. We don't own it, but I follow very closely. In theory, if you look at what's going on in Niger, if you look at what's going on in Namibia, those are low-grade deposits. Those are 200 parts per million. And if you think about what happened with the Reva's experience in Uranium, Reva had to write down Uranium to zero because it's a super low-grade deposit. Sure, it's large and bulky, but, if uranium stays at $50 a pound forever, those companies won't go in production. I mean, there's one particular Namibian company that needs $75 uranium to get a 15% IRR. Now, I don't think uranium goes that high, maybe, but that's not where our investors wish to be. So we watch South African. There's a big deposits there in South Africa. There's a lot of gold mines in South Africa that produce uranium. Also, we follow the Namibian explorers closely. Obviously, Malawi, Niger. I mean, I come from Africa, so that's my backyard. So I follow those very closely.
All right. Well, for our listeners, I warned you Russell is an encyclopedia of knowledge on these uranium stories. He seems to have in-depth analysis on each and every company that's out there. Russell, thank you for coming on the program. Before we end, I wanted to ask if you have any type of way for listeners to contact you if they have interest, or what the status of your natural resource fund is, if that's something that's closed or open for new interest.
Sure, it's open for new interest. You can Google me on Baobab Asset Management, or you can contact us at www.baobabllc.com, and be happy to take your questions. My email address is on the website.
Fantastic. Russell, thank you so much for coming on the show, and hope to get you back here with uranium market in better straits at the end of the year.
Thank you very much, Colin. I look forward to talking to your listeners again shortly.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen? Or are you too stupid?